Hey everybody, how's it going? Today what I'd like to do is read the perspective of a user on Reddit that has given me amazing information when I was looking for a new store. So when I was looking for a new store, I found a lot of the process ridiculous. There were spaces that had been available and vacant for 6 or 7 years that were still not lowering their asking rent at all. And I found this all to be very strange. And he gave information regarding how and why the commercial mortgage-backed securities market works the way it does and how that results in clusterfucks like the New York City real estate market. I really enjoyed reading what he had to say because reading what he had to say gave me an insight into a world that I probably would not have been able to understand. His posts were very simple, but also laid out with expert-level details that would allow a schmuck like me to understand everything that was going on. He's made a lot of posts on Reddit about everything that's been going on with GameStop and Wall Street bets, and genuinely do trust this person as a result of the posts that they have made in the past that were very accurate given my situation and the willingness that he had to be as open as he was with all of his information. Now, a lot of what you're reading here is going to be contrary to what you read on Wall Street Bets, but it's very important that you understand both perspectives. And one of the things that has aggravated me with this entire situation is there has been an unwillingness to understand any of these perspectives. When I read what I read in Bloomberg or I read what I read in the Washington Post, as I put in my last video, they're not even trying to understand. Again, we can have disagreements once we have said, okay, this is what this group is saying, or this is why this group is doing what they're doing, but they have not even made the basic attempt to understand why people are saying what they're saying. That's my beef when it comes to Bloomberg or a lot of the financial press or the Washington Post. I don't want this to be misconstrued as simply because I believe that the coverage from Bloomberg or the Washington Post is bad, that I simply believe and just swallow point blank everything that I see on Wall Street Bets. I don't. They likely have blind spots, and those blind spots should be considered. And people that lay things out like this, who I know to have been trustworthy in the past, I am going to read what they have to say. To be clear, this is not financial advice. I'm not a financial services professional, and I'm literally reading the opinion of an anonymous person on Reddit. So take that for what it is. That being said, we're going to get started. And I really hope that you sit through this entire video, even if you're not happy because this opinion is contrary to what you believe of your own. I think that you should be exposed to it. So we're going to start reading. He is responding to one person saying, when will the perspective throughout Reddit shift to realizing it wasn't propelled by retail day traders, but similarly huge competitive hedge funds? And Laminar says, this is insanely wrong, and the fact that this has any upvotes speaks to the poor state of this subreddit. Melvin Capital doesn't have shares to gobble up. They're private and don't have shares. They have LPs. And Melvin was not short GameStop in any size. They had a tiny put on GameStop, which expired last week and no more. Melvin didn't get margin called either. They were facing redemptions and got whacked on their long portfolio, which was in a bunch of illiquids. PT72 and Citadel entered into a revenue sharing agreement, which you never do in a teetering fund. You do that when you expect the fund to outperform. Source: I work at a hedge fund and I know all these people. Every hedge fund of a size runs a counterparty desk, and their sole job is to know exactly what's going on at other banks/hedge funds, your counterparties. Point 72 and Melvin are telling all desks they are/were fine, and this whole thing is kind of funny and weird. Melvin is down for the year, but nowhere near 30% on a gross AUM basis. And if you really want to argue, go find the source of the rumor that Melvin is short GameStop. There's a single 13F from November 2020 that shows a $50 million GameStop put, and nothing more. Short positions don't show up on filings, and nobody would know unless Melvin published their short. But that hasn't happened. So where is the source of this rumor? Find it. I dare you. I know news sites are reporting it as a fact, but I literally had a reporter from a major financial news outlet asking me if I knew where it came from. And I told the reporter, you know we're all laughing about this. There's no short squeeze. This is a pure play mania, and it will end just like past stock manias, badly. Lastly, if you don't know how, 1, a stock can have 110% short interest and still have a net long exposure, 2, how an individual fund can short a stock and simultaneously net long, you're going to get fucked when this corrects. Look at Melvin's November 13F filing. They absolutely had a $50 million put, which is a flavor of a short position. They put expired worthless on January 22nd, so they told the truth. But my point is that $50 million in a $20 billion portfolio is nothingness and definitely won't squeeze shit. GameStop is trading like $20 billion to $30 billion per hour. This is the part of the reason that Wall Street is laughing. To trigger a squeeze, you need a short position relative to the daily volume traded. So, if a stock has 10 billion of shares shorted and trades like 1 billion per day, that's a great setup for a squeeze. Why? Because there are not enough shares being traded for a fund to cover their position. So they have to bid up the market to induce more selling supply. Stock price goes up more, and that's a squeeze. On the other hand, GameStop is trading the entire short float multiple times per day. There's simply no way for a squeeze to happen mechanically. There are way too many shares openly being traded to make it difficult for a fund to cover their shorts. GameStop is one of the most liquid stocks in the market today. There's no there. People overuse the phrase Ponzi scheme, but this is exactly what is happening. The first people into GameStop will sell into the new people rushing in, and when there's no more new people, poof, goes the stock. Why is everyone acting like this is a new thing? I was around in 99 to 2000 for the dot-com crash. This is the same movie and it ends the same way. There is nothing new about this shit. Sorry for yelling. People keep asking my opinion. Here's the deal. People are strictly gambling. Accept that as an absolute truth. Okay, now we are in Vegas. If you're gambling with 1,000 and you lose it, fuck, you had stings, but it's not going to hurt you. Fuck it. Gambling is fun. We all love that. And if you walk away with 200, you had fun and you learned a lesson. However, if you're levered up 10-1 on options and losing 1,000 means you don't make rent, you have to quit right now. There was an article in the New York Post yesterday about a kid that mortgaged his parents' house to day trade stocks. When this shit crashes, that's how suicides happen. Next thread. No hedge fund has to buy in their shorts ever. Wall Street Bets has no fucking clue what's going on in reality. The short interest right now is either 1, options dealers hedging the insane number of puts outstanding and/or any synthetic positions out, and 2, it is trivial for a sophisticated hedge fund to have a short position in a stock and be net long, profiting when it goes up. In fact, the few funds playing this right now are doing precisely that. Point is, there is no guaranteed short squeeze and no fund is on the clock. Hedge funds can work their balance sheet until Wall Street Bets is a smoldering hole of tendies turned to ashes. And as for this AMC thing, this is literally hedge funds taking money from Wall Street Bets. They flipped the converts, and guess who bought it? Wall Street Bets. I'm sure they send their thanks while they are in private planes down to Barbuda. Source, @hedge fund. His response to someone else. One of the biggest scandals that will never be reported is how deep and totally the financial media is in the grasp of Wall Street. We use reporters all the time to leak what we want public. Whenever you hear sources report XYZ finance thing, it's because someone wanted that public. I talk to reporters all the time on background to explain complicated finance shit. It's just part of the job. The only field that's close is politics. I do bonds, so I have zero interest in GameStop directly. However, if I were long GameStop, betting it's going to go up, I would place to the following call to a reporter who I have known for a long time at a scummy site like Business Insider. Hey reporter, I gotta share this with you. I was just talking with a bunch of my friends at hedge funds. They are all crazy short and they are scared shitless. I'm convinced they are going to have to break and cover in the next few days. They are absolutely getting destroyed out there. Of course, I can't go on the record. And no, I can't confirm this, but you know that I talk to everyone out there. Okay, bye. Wall Street isn't scared and there's no revolution. This is mildly amusing to us. This will end like all the others. Funds that are involved are doing what's called flow trading, where they are simultaneously long and short. That is why the short interest isn't going down much. You stay neutral until there's a flow, and you either extend your longs or extend your shorts. In this case, your short is synthetic. It's complicated. And your longs are natural, like you just buy the stock. But you're just waiting until Wall Street Bets tuckers itself out and GameStop goes below $20. It might take 3 months or it might take a year, but the underlying company is a mess and has no future, turnaround or not. Next, hedge funds don't push anything. There's no pushing by anyone. In fact, equity traders, called position traders, are bonused on how little they move the market. Wall Street Bets has made up a fantasy world that is 1,000% divorced from reality. And to follow up on your edit, Robinhood got shut down because they couldn't calculate their VAR, value at risk, and a few other key financial stability metrics. There is a whole bunch of shit you have to know at all times as a brokerage, and Robinhood couldn't guarantee their numbers, so other big institutions legally could not trade with them. In plain English, other banks and trading partners said, Robinhood, there's a lot of shit going down. Exactly how much risk are you carrying, and how does it change with respect to changes in all these stocks? And Robinhood said, well, I've got bad reception. I'm going to call you back later. So they got restricted. They couldn't allow their aggregate portfolio to add more risk, so they had to encourage portfolio de-risking. That is why people could sell and not buy. As mad as Alexandria Ocasio-Cortez and Elizabeth Warren got yesterday, this is a safety regulation that was put in place following the 2008 crisis. Specifically, both Bear Stearns and Lehman collapsed in a similar, not identical fashion. If Warren wants to understand what happened at Robinhood, she needs to look in the mirror. Burn. This isn't about anyone's definition of fair. This is strictly about regulatory compliance. Robinhood was facing literally a life or death situation because other banks/funds couldn't trade with them. Again, Lehman and Bear failed because their trading partners walked away. There is a 100% chance that Robinhood is going to eventually pay massive fines to the SEC. Save this comment for when it happens. But stopping selling would not have fixed their regulatory issues. They needed people to stop buying and allow natural selling to de-risk their portfolio and stay alive. If you want to get into a larger debate about financial regulations and the perverse incentives they cause, I can go on for fucking hours. But Robinhood was facing a hard reality, and they had to make a tough choice. On Twitter, there were a ton of accounts saying that when Wall Street Bets realizes why Robinhood had to do what they did, people got strung out due to government regulations. A whole new breed of libertarians will be born, and they are probably right. His response to someone else: they didn't raise margin, they are in a bank. The issue was the ability to guarantee the capacity to meet the cash borrow requirements due, according to gossip, a total loss of risk control. They need certain criteria to be met, and Robinhood could not do it. From DTC's perspective, if Robinhood broke margin, it'd be like 5 million broken trades, which would have been a disaster. Believe me, financial tech as a sector is about to get fucked. Here, let's see. If you can look through my old post that got gold, I wrote about this a couple of times. People don't realize how close we got to the whole thing failing. We got really close. People that weren't involved don't realize how bad it could have been. Imagine McDonald's, Apple, Microsoft, or Walmart not making payroll. Imagine ATMs just being empty. Imagine all debit or credit cards just not working. We were right in the cusp for 72 hours. Our whole way of life exists in a very delicate precipice. Every banker who was there during the 2008 crisis keeps a get out of the U.S. today kid. Now, me included. And that was his response to someone saying that firms should have been able to crash in 2008. Next thread. I'm taking a break until this GameStop thing settled down. The amount of vitriol around this is ridiculous. To answer your question, I think the story is being slightly misreported. What is almost certainly happening is that one of their strategies is down 50%, but not the whole fund. The key thing to understand is that a $20 billion hedge fund isn't one big fund. It's probably like 10 to 20 different strategies under one parent roof. Every big hedge fund is set up like this. If you read the Bloomberg article, they have some key details, mainly that Citadel is only down about 1%. Citadel had a $1 billion long-term investment with Melvin prior to the Mew money. It is impossible for the whole fund to be down 50% and Citadel be down 1%. Those two things are impossible together. Also, when a whole fund goes down 50%, it just collapses. Google Amaranth and hedge fund as an example. Instead, Melvin is raising new money. The thing is that a fund down 50% can't raise new money, not because they just lost 50%, but because their risk control is so bad that they could lose 50%. Allocators cannot put money in a fund like that, so we know Melvin in total wasn't down 50%. The gossip on the street is that Melvin in total is down about 5% to 10% and has dumped a lot of illiquid long positions because that is where they were losing real money. 0.72 had a tough January, but is only down a few percent, not the 10 to 50% that's floating around, although I wouldn't be surprised if they had a few strats or sectors down that much, but not the total fund. Laminar flow. Unpopular opinion, but here goes. Wall Street Bets being shut down is the only way this is going to end. There's no happy ending to this movie, and it's going to happen really soon. A long time ago, I did securities law, so I'm speaking from direct experience here. Plus, I'm a PM at a hedge fund now. About 5% to 10% of posts and comments on Wall Street Bets are direct securities law violations. Touting, trading in rumors, falsification, non-disclosure, illegal disclosure, we can go for hours. The whole thing is like a securities law 101 class. You also need to understand there is no First Amendment protections around commercial speech and speech concerning markets/securities. I literally cannot stress this enough. The SEC will laugh in your eye when you say, but my free speech. This is very settled trial, administrative, and regulatory law. There's no debate here. You simply do not have a legal right to say whatever you want about stocks/securities, etc. when you are trading them too. This is not political speech or religious speech, and there are very different rules. Reddit really has no choice here, and it's the same reason they banned the Donald, Chapo, creep shots, fat people hate, and so on. It's just not worth the headache. And unlike the Donald/Chapo, Reddit can absolutely get fined for hosting and promoting a forum that's used for securities manipulation. We can debate if this is fair, but it's also reality. And no, the hedge funds are not out to get you. It's simply that there are 7 million Wall Street bettors that have no effing clue what they are doing, taking risks that nobody should take. Forget about professionals. These people are going to lose everything plus more. And then there are going to be suicides. It's what happened in 2000 and in 2008/2009. And it will happen again. That is why the SEC is going to step in. And after they close Wall Street bets, the next step is going to shut down Robinhood. This is almost certainly going to happen. And then watch for any direct or indirect leverage to be restricted to QIBs, something like 2 to 3 times cash secured accounts. Margin requirements are going to go way up. I'm sure you all don't like hearing this, but be realistic, it's definitely happening. Now, someone responded to him, and Laminar Flow responded back saying, commercial speech is different from companies engaging in speech. And if you want to research First Amendment versus securities law specifically, the controlling case is O'Rourke versus Ohio Bar Association. This is the controlling precedent for basically all cases of speech for financial gain, including pretty much all securities law. Put differently, this case is cited in every insider trading and stock manipulation case. There's a few other cases, but O'Rourke is the main precedent. And no, none of the speech I'm talking about on Wall Street Bets would pass the test under O'Rourke because it's, by definition, for financial gain. Hell, you can even make a compelling argument that a diamond hands emoji is made for financial gain or loss aversion. As far as other security law cases go pick a recent case like Dell Diamondback versus U.S. and go through the citations. Every defendant claims First Amendment and every defendant has that line tossed. Mark my words, the SEC is going to get involved and there are going to be enforcement actions that come out of this. And the filings are going to be effing hilarious. People that think the SEC is going to do nothing here are effing dumb. Now, the next post. 1. Robinhood is gamifying the stock market. In the SEC's view, the market is only for investing and not for playing around. It's super complicated, but there are a number of court decisions that reinforce this decision. And it's a bigger problem that Robinhood is being marketed as a way to play the market as opposed to investing. I could just as easily see the SEC making free trades illegal and re-regulating back to what it was in the 1990s. Imagine something like no fractional shares and minimum $5 per trade in an effort to discourage rapid-fire and irresponsible trading. 2, you are exactly right with options, and that's exactly why the SEC would do it. Options plus idiots equals horrible outcomes. Just watch for the GameStop fallout. It may take a year, but people with positive account balances today are going to lose it all. 3. Reg T is 1.5 to 1, if I recall correctly. I've actually never had a personal margin account because I've always been restricted in personal trading, and institutional accounts are very different. I'm saying the margin will be restricted way down. Then he responds to another post saying, we may have to fundamentally disagree, but one thing I firmly believe is that the SEC's insistence that retail investors can compete with hedge funds is a massive fucking lie. And we should be honest about it. I'm a PM at a credit fund. I spend about 10 hours per day every week or every year for 20 years devoted to my craft. I have a team of 10 people that work for me, and I have a research budget that's well into the 8 digits. Spending $500,000 on a data set is no big deal, and I'll spend into the millions for specialty data. The idea that some retail assholes can compete with that is fucking insane and should not be encouraged. If you played LeBron James one-on-one in basketball, could you beat him? LOL. You wouldn't even score in a game to 50. Do you think that you could get a hit on Trevor Bauer? No, not even with 100 at-bats. So why the fuck do amateurs think that they have a shot against hedge funds? Of course Wall Street Bets is going to get rolled over. It's not because hedge funds are cheating. It's because Wall Street Bets is playing a game it has no experience and capability in. It's stupidity. And speaking of understanding the game rules, short selling is absolutely necessary for a functional market, and a financial transaction tax would massively increase market dislocation, and it's also effectively a tax on the lower middle class. Hedge funds will never pay it. I want to be clear here that when I became aggravated 1 week ago when I started reading about this story, the thing that aggravated me the most was that what I would read in the mainstream media or the financial press would be mischaracterizing what people were saying on the Wall Street Bets forum. What aggravated me was the mischaracterization and ignoring their perspective. I thought that when I would read these articles, they were completely ignoring the perspective of Wall Street Bets, and they were also ignoring why they were doing the things that they were doing. And when I made videos in this channel, I would try to point out what was happening in real time as I saw it, but also try to tell you what their perspective was. At the same time, what bothers me here is that there are not a lot of people that are willing to listen to this perspective as well. And I think this is a perspective that needs to be listened to for people that are trying to get a true understanding of the story. There are very few people that actually work in high finance that are good at it, that are going to deconstruct the specifics of what they think of everything that's going on here, probably because they're afraid of an angry pitchfork mob, which is really sad. This gentleman was more than willing to lay out every single specific detail about what was going on when I was looking for a new store, and a lot of what he said, if not all of it from what I remember, wound up being accurate to the point. So while I can't say, because this is a person that I've never met before and don't know the credentials of or even the real name of, that this is all 100% factually correct, my inclination is to trust quite a bit of what he is saying as just an industry insider that wants to tell it like it is, the same way that when I am discussing what's going on with board repair or something else like that. That's the kind of stuff that's the vibe that I'm getting from this. It's kind of like that whole shop talk vibe of somebody who knows what's going on and is more than happy and willing to give citations and say, here's what I think is BS, here's what I think is true, and here's why, given proof and evidence. But you let me know what you think in the comments down below. That's about it for today. As always, I hope you learned something. And just something that I want to cover. To be clear, this is not financial advice. I am not a financial services professional. This is only my opinion. A lot of people are saying that I'm going to spend all of this money on GME, and if it goes to zero, it's worth it to give a middle finger to the man. I want you to really think for a moment about whether or not that rhetoric matches reality. Now, if someone purchased one share and they say that, I might be likely to believe them. But if someone has purchased hundreds of shares or 50 or 1,000 or whatever, or an amount of money that means something, if you have 10,000 or 20,000 or even 5,000 in this, and you're someone that doesn't have a lot of money, really think to yourself, am I being honest with myself? Because one of the problems that I've had throughout my entire life, one of the things that's always screwed me the most is when I'm not honest with myself. I can't be honest with others if I'm not honest with myself, because if I lie to myself and believe it, then I'm not lying to you when I'm bullshitting you. I'm telling you the truth as I believe it after I've lied to myself. And I try to check myself on that. Be very careful. If you're ahead of the game at all, honestly, even if you're behind, just think to yourself, when you say, and if you believe it, that I'm not going to say you don't believe it. When you say, I want to stick it to the man, I want to go down with the ship,